Gold price has a lot of reasons
Yeah.
that it should be down. Okay, and we were talking about this on a panel yesterday.
Inflation's down, interest rates up. Yeah.
Real interest rates are wonky, and all these. If you looked at these things in like a paper in school, you would say, yeah, definitely gold's 1,500. I mean, you would think, but it's not. It's at an all-time high, and as you can see, it keeps banging on this all-time high and sitting here, and it's ready to go to 2150. I think is the target this year. And so basically, when you see that something is defying logic, you can tell that it's going to go more. And Bitcoin's the same thing.
EBTucker, the editor of the Tucker Letter, recently shared insights on the major risks and opportunities facing investors in 2024 and beyond. Despite economic indicators such as inflation and real interest rates typically suggesting a lower gold price, Tucker notes that gold is currently at an all-time high and exhibiting strength. There are expectations in the market for the Federal Reserve to cut interest rates this year, although the likelihood of this happening in June appears to be diminishing. The delay in rate cuts could potentially put pressure on gold prices. However, Tucker remains optimistic about further gains in gold, setting a target price of $2,150 for the year ahead. Meanwhile, Peter Schiff's outlook on gold is also bullish. He interprets recent price movements, particularly the dip below $2,000 per ounce, as a potential precursor to gold achieving new highs. According to Trading Economics' global macro models and analysts' expectations, gold is projected to trade at $2,046.66 per ounce by the end of this quarter. Tucker further suggests that while the Fed may reduce its balance sheet from $7.5 trillion to $7 trillion, and possibly down to $6 trillion, this reduction might not necessarily have a negative impact on equity markets and gold, as the market is accustomed to a managed environment. In a related development, the U.S. Federal Reserve's balance sheet expanded to a record size in the latest week, as the central bank bought more bonds to support the economy. Considering these factors, how do you perceive the current market situation, and what are your expectations for gold and other assets shortly? Join us as we delve into insights shared by EBTucker. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Gold price has a lot of reasons
Yeah.
that it should be down. Okay, and we were talking about this on a panel yesterday.
Inflation's down, interest rates up. Yeah.
Real interest rates are wonky, and all these. If you looked at these things in like a paper in school, you would say, yeah, definitely gold's 1,500. I mean, you would think, but it's not. It's at an all-time high, and as you can see, it keeps banging on this all-time high and sitting here, and it's ready to go to 2150. I think is the target this year. And so basically, when you see that something is defying logic, you can tell that it's going to go more. And Bitcoin's the same thing. It's the same thing. And so and stocks have done the same thing, which is wild because some stocks are trading at 10 times earnings in the market, like some old companies here, and then some new companies are trading at 80 times earnings. I mean, we have a company in the portfolio of the newsletter that's up like I don't know 50% since we recommended it. Okay, somebody wrote into me complaining it's at like a 75 PE. I said I hate to be the bearer of bad news, but it's probably going to earn into that and go higher. The balance sheet got to 9 trillion. It's back to 7.5. Okay, and it's probably going to 7. I think 7's kind of the magic number for a couple of different reasons. They're somewhat complicated, but I think 7 is the number to watch. And when that happens, I think we want to see what is the Fed going to do this time. It's going to be different. It's not going to be the same thing. I think they'll probably support the Treasury market. I don't think they'll support the mortgage market. So I think it's like where will they push their money cannon, and shoot the money. They have to manage the system. They want to manage where there's not long-term depressed periods. They want to manage against having a depression type scenario. And what that means is unintended consequences. And so we're going to have to be positioned to things that have limited supply and are going to see capital inflow. And yeah, I mean, so I think we're ready for that. I mean, I think we're sitting back. That's probably like second quarter. I think it's probably like the time for that. I mean, they're pulling 90 billion a month out of the market right now.
Right.
They've written papers about it. I mean, nobody reads this stuff, but I read this stuff. But I think probably second quarter that's down to a level where there's some shaking and then they step in.
Okay, so there's a reduction in the balance sheet. Is that necessarily going to be good for the equity markets, you think?
Well, okay. The reduction of the balance sheet, you would think, is bad for equities and it's bad for gold and it's bad for Bitcoin. And it's actually not. It's not been the case, right?
Right.
And that's because we live in this period where everybody, it's like if you have a dog, for example, whenever you walk over to the cabinet and get out anything plastic,
Yeah.
the dog immediately wakes up from a deep sleep and is like, oh, this is gonna be a snack for me. So this is how we think about the Fed now, and you're never going back from that, right? I mean, there's people that are in their late 30s, that's all they've known is a managed market, and so we hear the snacks rattling.
We're all Pavlov's dogs.
We're just sure that there's something really great about to come out of the cabinet.
In response to the ongoing war in the Middle East, investors and firms are raising concerns about the potential impact on earnings, as boycotts and supply chain disruptions threaten sales and logistics. These challenges are seen as risks to the record-setting rally in U.S. stocks, with analysts' expectations for profits at S&P 500 companies hitting all-time highs. This optimistic outlook, based on assumptions of robust economic growth and potential rate cuts by the Federal Reserve, could be jeopardized if there are any significant disruptions to earnings or signs of a resurgence in inflation. Such developments could undermine the market's bullish momentum and impact the record-breaking performance of the U.S. benchmark. EBTucker echoes these concerns about market risks, particularly in light of the current surge in stock prices. He cautions against potential sharp declines and emphasizes the importance of liquidity during periods of market volatility. As a precaution, Tucker holds a smaller proportion of stocks than he would prefer, anticipating the opportunity to buy more at lower prices if market weakness presents itself. Let's get back to the interview.
The biggest thing that I'm worried about is stocks that are going up right now. SPY hit a high last week. Stocks that are going up right now are all being driven by funds that don't actually own the stock. They're trading options, and then the dealers have to bid that up. And so you have a big air pocket there. And so if there's a period where the Fed finishes pulling money out, you got to watch the PR of the Fed, okay? They have a big PR machine. And they say, well, maybe we're not going to accommodate as soon as we thought. You have these big drops that go on. And then I think during these big drops, there's a big need for liquidity, and they get the liquidity out of the market. And so the stocks that I own them in a little bit smaller percentage than I would like, because I'm pretty convinced that I'm going to be able to top up on weakness. If you remember, 2009, Bank of America traded for 3. Okay, like 3, okay? Yeah. And now your dividends are like, a huge percentage of that price. And so I think you always want to have just a tiny bit. You don't want to be extreme. You don't want to be all in, all out, okay? But I think you want to have a tiny bit left in the cannon, so that if something happens quickly, like during COVID, remember, it's 3 weeks. You had 3 weeks of market turmoil, and then it kicked the other way, right? So it'd be wise to have 1 foot in and, maybe like a toe out still. And that way it gives you some flexibility to get back in. When we look back from 2030, we're gonna say how we had a whole paradigm shift of how we interact with data, and it all happened off this cyber panic. And now our data, our privacy is all tied to a new way of thinking about cyber. And so there's companies right now that are super interesting to me that I think are gonna lead the charge of providing those services. And it's kind of like if you saw the automobile coming and you got in the tire business. It's like, you don't overthink it. You just say, all I know is I saw this guy, Henry Ford, he's gonna make cars for everybody. I'm gonna get in the tire business, okay? And if you did that, and your name was Mr. Goodyear, you ended up making so much money, you built a museum to put all your art in, okay? So that's something we spent a lot of time on, because I think cybersecurity is something people wouldn't have expected me to write about, but it's an industry where you want to have some exposure.
Time to get in early in the decade.
Super easy. I mean, you look at these companies and everybody's business. If you're a regular person working at a company, you got a cyber chief, they have no idea what to do. They're just trying to do anything to keep their job, because there's events happening all the time. There's data breaches, there's scams going on, phishing, all these things. You gotta have your phone, you log in a website, you gotta have your phone to get a code. It's nonsense. The whole thing is nonsense. And I have a hacker buddy that helps me with putting together like how to think about this, and he doesn't use any encryption. And I said, why? And he goes, there's no reason to hide what everyone already knows you have on your phone or whatever. And it's a good way of thinking about it, is that you're entering this time where our interface with our portal to the world is this telephone. And the business of protecting that data is a great business to be in.
Despite economic indicators suggesting a potential decline in gold prices, gold is currently at an all-time high, indicating strength in the market. The expectation of Federal Reserve interest rate cuts, although potentially delayed, adds complexity to the market dynamics, with implications for gold and other assets. How do you evaluate the current market landscape And what are your expectations for gold and other assets in the near future? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.